Good morning and welcome to this Monday, June 22nd edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We're kind of in that time of June. We got to be a little careful, not just June, but any month. I'll give you some numbers on Mondays in just a bit, but Mondays overall aren't good. And then you get to Mondays this time of the month after options expire, and really it's not typically a very good period of the calendar month for the market. So we'll see what happens in the very near term. Big picture, I still love the market. The more I look at it, the more I love it. I know, we get all these negative stories out everywhere. I'm just ignoring them. I just, I got to see it on the charts. I don't care what anyone says or what everyone's opinion is and how the market shouldn't be going up because of this, that, or the other. I just look at the charts and look at what's leading the market and ignore everything else. So I try to focus. I don't look at any TVs. I don't do anything while I'm, following the market throughout the day. I tend to just try to stay in my own world and objectively look at the market. And we're going to get into that market and what happened at the end of last week. But first, I'm going to show you, if you are not, I need to be able to share the screen here. There we go. Thank you, Chris. Let's see here. So let's take a look, first of all, for those who are not Earnings Beats members currently, or Earnings Beats Digest members, I should say. It's a free subscription service. We publish Monday, Wednesday, Friday. Had an article out this morning. All you have to do is just type in your name, email address, hit the subscribe button, and we'll make sure that you are added to the list. You can unsubscribe at any time, no credit card required. So it's really easy and it's educational. I think there are some good trading ideas from time to time. But for the most part, we try to just make it very educational, try to get folks to learn a little bit more about the market, things that you should be looking for when you buy a stock or consider buying a stock, or maybe it's about an industry group. But we really focus on relative strength. We focus on leaders in leading industry groups. There's a reason why Wall Street's putting their money into these stocks. And you're always going to have the naysayers saying they're overpriced, the PE multiples this, blah, blah, blah. But the bottom line is, if money's rotating into an industry group, and then within the industry group, you've got a leader, then it just makes sense. The momentum will carry the stock higher. Now, are there risks? Of course, there's risks in every investment that you make. But I'm not going to not invest because this might happen or that might happen. I'd rather just stick with what is happening. All right, so let's go ahead and move on to the market from Friday. It was kind of an interesting day because midday Apple came out and just stoked those coronavirus flames a little bit. Apple announced that because of the spike in coronavirus cases in Arizona and Florida, that they would be looking to potentially close some stores or actually close some stores. And the market immediately, you saw a big drop. But market came back toward the end of the day, didn't fall. I actually thought we might have a pretty big sell event on Friday afternoon when Apple came out with that announcement, just because it was options expiration day. I even talked to John Hopkins. I was like, should I be thinking something about this conspiracy theory? Here it is, Friday, options expiration, and at noon, the market's sitting near a high, and Apple comes out and makes this announcement. Always seems to happen on option expiration Friday, or right before it, or right after it. There always seems to be a big announcement. And so as soon as the market started getting hit, I'm like, really? And I'll be honest, I ended up getting stopped out of a lot of things. And what I didn't get stopped out of, for the most part, I decided to take off the table because I really thought that was we might spiral to the downside, at least for a couple of days, just given the time of the month. I was like, okay, here it is. Here's the news story. Because John and I were already joking earlier in the day, and I think on Thursday, it's like, what's the story? What's going to happen? Something's going to happen. The bottom's going to drop. And then that news story literally right around noon on Friday, and market quickly sold off. I was like, okay, here we go. But I tell you what, this market is showing tremendous resiliency. It seems like every time prices go on sale a little bit, you've got buyers out there, and we can ignore it if you want, but it was just another, confirming piece of this story to me that with Apple coming out, talking about reclosing stores that had been opened, you would think that would trigger more selling than it did. It actually did trigger initial selling, but then we bounced back. Anyhow, we did finish down. The Dow Jones was down 209 points. The S&P was down 17. NASDAQ, however, managed to still stay in positive territory. There's that relative strength in the NASDAQ again. I don't want to keep beating this dead horse, but I'm telling you, the market is valuing the companies that can grow earnings in a historically low interest rate environment, with the Fed telling us that these rates are going to stay low for the next couple of years. Wall Street is loving. They've got a love affair with these companies that can grow earnings and do it at a pretty good pace, especially in a somewhat of a panicked environment. Not as panicked as it was a couple of months ago, but there's still a lot of folks very fearful, and for good reason from a health perspective. I'm not trying to diminish the severity of this pandemic at all from a health perspective. But the stock market is not a doctor's office. The stock market is looking ahead at economic reports, what they see what the market as a whole collectively sees down the road. And what the market's telling us is this is a V-shaped bottom. We went down, we had to close up. The market was horrible. The economy was horrible. The market priced it in before we got all the reports. I mean, as soon as the market began to sense that things were heading in the wrong direction, it was a sell now and ask questions later environment. And that's what we saw back here in this March period. I mean, you can see all the major indices straight down, 1/3 of all the value of companies in the U.S. These multinational, massive companies, 1/3 of the value gone in about 4 weeks. Market discounts, the market prices in really bad stuff. Prior to this, we were in a good economic cycle. And I've said before, and I'll say it again, I am very thankful, and we all should feel blessed that this did not occur, that this pandemic did not occur back in 2008, because I believe that would have thrown us into the Great Depression. We already had a financial system teetering on collapse. That, I think, could have just thrown us over the edge. If there's one silver lining in all this, is that that the pandemic occurred when we had one of the strongest economic backdrops probably in the last 5-6 decades. And so while it was bad, the economy was able to weather it. And as soon as the market anticipated reopenings, you saw the market going back up. And to be quite honest, there were a lot of companies that were doing better with the pandemic. Any company that's focused online with everybody in their homes all day long with nothing to do but to get on their computer, those companies benefited. Look at companies like Wayfair. That company 3 or 4 months ago was just languishing. And then all of a sudden, this fell into their lap. Peloton, sells the equipment to exercise at home. They do these virtual classes. You can exercise with somebody over in Southeast Asia, and it's an environment that works for a lot of companies. And there were also companies that were already doing pretty well that this played into their lap. Think about Netflix, think about Amazon, companies like that. So this wasn't all bad news for everybody. And so that's what we had this little divergence going on. And I still think that there's a divergence that we need to pay attention to, where we've got certain companies that are doing extremely well and have continued to do well through this pandemic and will be even stronger on the other side of it because of the market share they're gaining. And then you have other companies and industries that truly have been wrecked by this pandemic. I mean, airlines, cruise lines, I don't know when those areas are going to be fully, operational and back at capacity. I'm not sure when it's going to happen. How about hotels? When are people literally going to be traveling and staying in hotels at the rate they were 3 months ago or 4 months ago? Gambling stocks, same thing. I mean, yeah, there's a group of people that'll go to Vegas and go out in these casinos and all, but there's a lot of people that won't. When are we going to be back to 100% there? I don't know. Going to be a while. So the recovery is completely different in different areas of the market. And I think we have to recognize that. That's what we've been doing at Earnings Beats by putting together our various chart lists. We have the strong AD, the weak AD. That's a strong accumulation distribution chart list, the weak accumulation distribution chart list. I'm still using this accumulation distribution on the bottom of my charts. I'm not sure it's as meaningful today as it was 3 months ago, but I still think it's meaningful. I don't use it as a primary indicator for me. If I see a stock, I like it, it's breaking out, and I look down and I see the accumulation distribution isn't very strong, it might, you know, if I looked at two stocks and one's got a strong accumulation distribution, the other one's got a weak one, that could be the differentiator for me as to which one I buy. But if I like a stock and it's breaking out, it's in a strong group, I'm not going to not buy it simply because the accumulation distribution isn't confirming. So things for me have changed a little bit, but I still think it's an important indicator to have. And for those of you who aren't familiar with this indicator, literally it doesn't care whether you gap down or gap up. And so when we were doing all of this gapping down, the one thing that stood out to me as I was doing research through all this is that essentially the entire move to the downside was just a collection of all these gaps. It was just the net of all the gaps. Throughout the trading day, the market wasn't selling off. It was just at the open. And so that was creating an environment where, in my opinion, individuals were panicking out because of all the fear being stirred up by the media. And I know there's some of you who don't agree with me about the media, and that's fine. Everybody's welcome to their opinion. I think the media was a major contributor to the market dropping back in March. I mean, it was impacting me. I know what it was doing to me. You know, I was waking up every morning, you know, market down, Dow down another 1,000 points, another 1,500 points. I mean, that wears on you when that's everything you see, whether you turn on the TV, whether you turn on and, you know, go to your internet, your favorite news place, you go on social media. It didn't matter where you went. Everybody was talking about this market collapse. Say what you want, but that'll feed on you. I mean, you know, you're going to eventually crater under that kind of emotional stress. But this move down was not like anything we saw back in 2008. I mean, there was literally selling throughout the day. We saw mass distribution by professionals. Everybody was getting out. There was a potential financial collapse. There were a lot of smart folks using all of this movement to the downside to accumulate, realizing that this is going to pass pretty quickly. And we had a strong economy before it hit, and we're going to have a strong economy after it hit. So what we were seeing with the accumulation distribution is airlines, cruise lines, all those kinds of companies kept seeing their accumulation distribution going down. But other areas, like some of the broadline retailers that had great online presence, many of those companies were showing very strong accumulation distribution because, again, the impact of those gaps at the open, the gap downs, aren't reflected in the accumulation distribution. It's how you trade during the day. Do you trade at the upper end? Do you close at the upper end of your range, or do you close at the bottom end of your range? If you're closing at the upper end of that trading day's range, it's a positive. Even if you finish down 1,000 points on the Dow, you know, you could have had a stock like Amazon that gapped down 100 points, but comes back and gets 90 points of it back during the day. So it finishes down 10, but on the accumulation distribution, that's a positive day because you gapped down 100 and you rallied back 90. Professionals don't get out of the market on a gap down at the open. They don't put in a market order for 3 million shares. It's not the way professionals get out of the market. They've got to get out during the trading day. It wasn't happening. Anyway, I could go on and on, already taken up too much time here. But on Friday, you can see market overall, I think, held up pretty well, given the Apple news. We did see a little bit of weakness in mid caps and small caps particularly, a little over 1% move to the downside. All the uptrends still in play, though. I don't see anything overly negative about these charts. The one group that finished positive on Friday, and this is interesting, healthcare. And we know healthcare looked like had a false breakdown about a week and a half ago. This group has come roaring back. And I'll tell you, the key area in that group, and I've been saying it for a while, and they broke out on Friday, biotechs. I think this is going to be one of the strongest areas of the market throughout not just 2020, but I think could be for the next few years, next couple years. I really like the biotechs. I've talked about it before. I'll be talking about it a lot more, but just keep that group in mind, at least keep them on your radar. As far as the weak groups, these were your 4 laggards. Take a look at who they are. Utilities, energy, industrials, real estate. Sounds a lot like March to me. Same groups, different numbers, different time period, but basically the market is once again showing us that this pandemic has caused a paradigm shift in the market. And so we're seeing companies all of a sudden that are leading the market that maybe weren't doing so well before. This has kind of changed the way we're all doing business and the way we approach business and the way we approach shopping and everything else in our lives. All right, 10-year Treasury yield. First of all, we only have one economic report out this morning. It'll be May existing home sales, be out at 10 a.m. The estimate is for 4.29 million units, and April was 4.33 million. So we're looking for a little bit of a pullback in the existing home sales. I'm thinking it's going to be a bit better number than that, but we'll see. As far as the 10-year Treasury yield goes, I'm going to just annotate this quickly because if you look at the trend line off of the lows here, something like that, you can kind of see that the low in March, low again in April, low in May, low in June. I think we've got a pretty well established short-term uptrend line here in the yield. And then I think if we look just recently at lows, we're looking here at about 0.65% at the end of, middle part of May, end of May, again, middle part of June. I think if you go back down on this yield below 0.65%, you're violating trendline support and yield support, this horizontal line. So that would suggest to me maybe more downside in the yield, or that maybe we're going to go back to one of these other support levels and consolidate further. The significance there is that normally the best moves in the stock market come with a corresponding move up in Treasury yields, a move up in Treasury yields. That might go against, what you might think from a common sense perspective. You'd think, hey, the stock market should go up when rates come down. But it's really not that. It's when the market is less fearful, money comes out of treasuries. When the market is bullish on the economy going forward, money comes out of treasuries. That money, when it comes out of treasuries, sends the yield higher. Selling of treasuries sends yields higher. Always that inverse relationship. So treasury prices go down, yields go up. All right. When treasury prices are going down because of selling, you get a lot of proceeds. Where does the proceeds go? Well, if it's less fear and the economy is going to strengthen, that money should rotate into equities. So if you go back and you study history, you'll see that some of the best moves in the equity market are when yields are rising. Now, does that mean we can't go up if the yields are falling? No, because you've always got new money coming into the market. What I'm talking about here is strictly the relationship between the bond market and the stock market and the rotation that takes place. New money can continue to come into the stock market. And sometimes yields go down because of new money coming into the treasury market. Doesn't have to be strictly rotation back and forth. What I'm saying, though, is if you are getting that rotation, then you've got the stock market getting new money and money rotating from treasuries. And that's normally when we see big moves to the upside. That's why I always like to see the treasury yield moving up. Last week, you can see it was moving down, but the market really didn't fall. Market went sideways for a bit. But typically, when the yield is on the move to the upside, that is when you're going to get the biggest moves on the S&P 500. So we really would like to hold this area. If we break down, I think it's just going to be one more obstacle, a big obstacle for the stock market to move higher. All right. Let's take a look at Apple, because Apple came out with the news on Friday, and you can see it traded down as low as 345, but it came back and closed at 349. So if we look at Apple on an intraday basis, here was the announcement. So we gapped up, we came back down, looked like we were maybe going to fill the gap, maybe turn back up, who knows. Here was your announcement, that big red candle. Look at the volume pickup. Apple announces Noon on Friday, we're going to shut down some of our stores that we had opened. We're going to reclose them in Florida and Arizona because of the spiking coronavirus cases. Now, we took out pretty important support level there, around 349, just from the last few days. Now, this is not a major support level, just talking about in the very short term. Rebounded, and then we started going lower again. I'm like, okay, this is it. Market's going to sell off. Been thinking, it's option expiration week. Wouldn't be awful to sell off for a bit. So this is where, it's happening. This is the story that's going to start it. And then look at what happened in the close. Came right back up, closed back up near 350 on Apple. You look at something like the NDX. I'm going to annotate this because I was watching the NDX very closely, and I was actually talking to John, and I'm like, if we go down and we take out that low right here, after, moving up, going sideways here for a bit, here was the news. That was the Apple news. Lost 100 points on the NASDAQ 100 quickly. Went all the way back up to about where we were and then started dropping. And if you see this intraday move, we actually went to that 3-day low there. So we had completely filled this gap over here, 3-day low. I thought that was going to trigger a lot of selling. And instead, market rebounded, went the other way. So again, technically, I think there was a lot of sellers, but the market went up anyway. So what does that tell you? There are more buyers. I mean, that close was very strong on Friday, given the news that had come out. So I don't know. I think that we got to respect what the market's telling us. And I can come up with multiple reasons why the market should have sold off on Friday. And it had a perfect technical reason to do so, and it didn't. And will it happen this week? It does sometimes, week after options expiration. I'm always cautious this week. But we'll see. Is the market going to remain resilient every time we try to sell off? Are we going to continue to see the buyers step up? Very possible. I think this week is kind of, I'm not going to say make or break, because I think the market's going higher whether we go down this week or not. But I think if the bears are going to be able to get control of the action even in the short term, I think this is the week. I think this is their time. If they can't do it this week, I think it's going to become much, much less likely as we move forward and head toward earnings. All right. So let's go ahead and move on. So I want to show you a little bit about our chart lists. The first thing I want to do is just go over to earnings beats, because I've been getting some questions about chart lists and scanning and so forth. And I thought, well, I'll just put it in a show, because I can't respond to everybody individually and explain to them how to use stock charts. It really is hard. I want to do it, but I can't just do it in one sentence. So in order to try to reach out to people who are having different questions, I thought I would just go through here kind of quickly and show you how, you can use some of these scanning strategies, because it seems like this is the question that's coming up. One big one is with it's really all of these various charts, but let's try, I'm just going to use scan number 3 here, which is the scan for the 20-day EMA test. So it's a pullback scan. You're looking for stocks that have been strong. So you can run it against, say, the strong earnings chart list. And that's what I'll do here. So I'm going to go ahead and copy, and I'm going to go over to the scans. So this is on your dashboard over at Stock Charts. And just scroll down to get your scans. If you don't see their scans, then you probably haven't done this little gear shift thingy over here. See how you got to check these things to show. So if I don't have this checked and I save preferences, now I go down, you'll be looking, you're just like, well, I don't have scans on my screen. Well, you have to make sure you click on this and check that box. So I've got the additional data panels, scans and alerts, chart list panels. For now, I'll get rid of the commentary. That was just, adding something there at the bottom, but here's your scans. Okay. So I want to do a new scan. So I just copied over, that scan syntax over at our website. And so I come in here and I can get rid of all this. I don't need to worry about the volume being a certain amount, to be honest, because we're going to scan against the chart list, and the chart list already has a filter for volume. Stocks wouldn't be on that chart, any of our chart lists, if it has volume less than 40,000 a day. So I'm going to get rid of all this. And there were only stocks in these chart lists, so I don't need to put type equal stock. But let me go ahead and put so there's the scan. So I copied it from the website. I brought it over here. Now you can change things if you want. You might say, I really only want if the scooter's over 85. I don't, 75 is nice, but I want 85. Okay, that's fine. All right, now if I run the scan, and I'm getting a question a lot. Folks are saying, okay, I'm running the scan. First, check syntax. Always check syntax. Okay, it says it's correct. So if you got the syntax wrong, nothing's going to work. So make sure you got that right. You might not have copied it right, or maybe you left out a bracket, whatever. Anyhow, so now I'm going to run the scan. Now, if you look at the scan, I'm getting indexes and I'm getting questions. Well, why am I getting indexes? And then why am I getting all these stocks? Look at the volume here. It's only 8,000 shares. So I'll get that question sometimes. I'm getting stocks that aren't liquid. I'm getting, stocks on the Toronto exchange. I'm getting, I'm getting ETFs. I'm getting whatever. I'm getting a lot of individual questions, and I don't want to respond to everybody individually just because it'll take so much time. So I want to just point out, make sure if you're a Stock Charts member, earning extra member or above, you can download our chart list from our website. Once you've downloaded the chart list, I don't have the chart list included in here because Stock Charts is assigning a chart list sequence in my account that is going to be different than the way they assign it in your account. So if I put my Stock Charts chart list on this scan and you copy it and apply it to your account, it's not going to work. Stock Charts is not going to recognize my chart list and the way it's numbered in my account in your account. All right, so you have to go in and pick your chart list that you want to use against, okay? So the filter, I'm going to use a strong earnings chart list. So I'm going to add that. Now when you go up, see how it's calling it my favorites list is 55? Maybe it's 85 in your account. So you just want to make sure that you go down and select which chart list you want to run it against. All right, so check syntax. And now it's fine. So now I'm going to run it. And now I've got 9. All right, so now I've got only the stocks coming off of my strong earnings chart list or yours. Make sure you filter using your own chart list, add the chart list you want. And then look at the scooters. You don't see anything between 75 and 85, right? Look at the volume. You don't see any light volume because, again, it's already looking at this chart list where volume was used as a filter. Now I can sort this based on scooter. And now of these 9, I can actually look to see which ones have the higher scooter score. Stock Charts technical rank, if you're not familiar with that. Developed by John Murphy. It's a form of relative strength. My favorite form of relative strength is simply look at a price relative chart. Take a look at MDB relative to the software index. Take a look at MDB relative to the S&P 500 and watch the line over the last year, maybe over the last 5 years if you want. The problem with the scooter, and this is one limitation, is that if you've got a strong stock for the last 5 months, it's going to have a high scooter score. If it was horrible last year, you're not going to know it by the scooter. So what you can sometimes see in the scooter score is a stock that's been downtrending for 10 years and it's had a good 6-month period and all of a sudden looks like it's the best thing since sliced bread. Got to be careful there because scooters don't look back beyond about 5 to 6 months. I think it's using a 125-day rate of change, I think, which, if you figure 22 days are in a calendar month, 22 trading days, that's about 6 months, a little less, maybe 5.5 months. That's as far as it goes back when it's comparing to other stocks. So that would be the one limitation on the scooter. Because I have had that question come up before. Somebody's looking at a weekly chart and they're like, this stock's been in a downtrend for 10 years. Why is the scooter 99? That's why. All right. Now, once you have scanned against a chart list, you can then save it. You can replace. What I do is I keep a scans results folder, a couple of them maybe. So I can take these and then I can just put them into scan results. You can have different categories. I mean, this is an RSI. I could have had a a scan folder for 20-day test. I don't have one. I just throw it in here in my other. And then I update it. And now here are those 9 stocks in this scan results. Now I can pull it up in my 10 per page, and I can look at it like whatever my default chart setting is. So I can quickly look at AXNX. Oh, we're past 9:30. We got a new day started here. But anyway, you can kind of look at these charts now that we're getting 20-day tests and make a decision. Okay. All right. One other thing I'll show you on the scans, and I'm going to go into the 3 you must see, and we'll wrap this up. This is something else you can do with the scan, which I think is pretty cool. So you might say, gee, I wonder, Tom's got the short squeeze chart list. I wonder how many of those are also strong earnings. How many of those short squeeze chart lists are also on our flagship strong earnings chart list? Well, it's easy to do that. If you have all these chart lists downloaded into your account, go down, and there's the short squeeze chart list, add it. All right, there it is. Now go down here and add strong earnings chart list. And what it's going to do is it's going to tell you any stock that is in both of these lists. So you don't need to go back and try to manually calculate this. This is going to be really fast. Check syntax. It's good. Run scan. 6 of them. 6 stocks. Look at Wayfair. You want to know why Wayfair has been so strong? Well, one of the reasons is it's also heavily shorted. One company I really like is this Lovesac company. They just came out with earnings, blew away estimates. And this stock has been in a nice uptrend. Look at this. I liked it when it broke out above about $17, $18, and now it's got short squeeze going on. So any kind of a nice technical support level, like if we pulled back at the 20-day or maybe near these recent lows, something like that might make sense, because not only is it on our strong earnings chart list, but it's also on our short squeeze chart list. That's a good combination. So anyway, I think that's kind of cool to be able to use these different chart lists and filter against one another. So you can go in and physically say, how about the short squeeze list in the week AD? Could do the same thing. Just take the strong earnings out, put the week AD list. Or you might say, okay, short squeeze, and how about, let's go in and find strong AD. I mean, these now are starting to show some strong characteristics. And, maybe we can get a short squeeze on one of these strong AD stocks. Check syntax, good to go, run scan. 9 of them. So 9 of these are and I would sort it by scooter. These 5 right here would get my attention pretty quick. And Wayfair, there it is again, right on the top. Look at PetMed. This is one I'm waiting on. I'm kind of watching this stock. I think it's in a nice little triangle pattern. I'm just waiting on this one to break. Either break or maybe even, even below 34 on Friday. I didn't catch it at the bottom, but, triangle pattern, it was getting pretty close to that bottom triangle line. But, see how quick you can maneuver these chart lists to find some good candidates to quickly look at. I think it's really cool. And then these others, like I said, Wayfair. Look at what Wayfair was doing back. I mean, it was in this downtrend in February. It gapped down, looked horrible. Look at the accumulation distribution line rising while prices are falling through the floor. And then look what happened afterwards. This was your signal that there was accumulation taking place. Even though the stock went from 120 down to 20, the AD line was starting to show higher lows. And even if you didn't catch it at the bottom, by the time you're getting up through the 20-day, we were setting new highs on the AD line. This has been a great stock, and it's a short squeeze candidate because everybody was betting against Wayfair. And trust me, anybody that was shorting this stock and was trying to impose their will on the market has really been getting hit hard. This thing just seems to show no signs of slowing down. Wayfair has been very strong. All right, let me just give you the last 3 here you must see, and then we'll wrap up for today. First stock I wanted to look at is GFI. I'm not a big gold fan, but if I were to look for gold stocks, and this one gapped up again today, if I was going to look for gold stocks, I would do a couple of things. Number one, I want a stock that looks pretty good technically. So I've got this move up. See how we got this support 7.25, resistance up near about 8.5, 8.75. I think that's a nice little flag off of an uptrend. So if I didn't know what stock it was and I didn't know which industry group it was in, I was just looking at the chart, I would say, hey, this looks pretty good. Came down, PPO, center line, starting to turn back up. I mean, this is definitely a stock that I would be interested in if I didn't know it was gold. I'm not going to trade it because I'm not a big gold fan, but look at the gold, look at it relative to the gold mining index. Do you see the strength? So if I'm going to get into gold, if I was going to do gold, which I'm not a fan of, I definitely want to do a leader. I don't want to do a laggard. Now, GFI, because it's right up against resistance, maybe it makes the breakout, but maybe this sideways consolidation continues for a while. I think this is probably the worst time to buy it because you're right at resistance. I'd either have to see it get through or maybe pull back, fill a gap. I'd have to see more confirmation. But GFI, I just wanted to point out because it is one of the leaders in gold mining. So if you like that area, again, for me, I just want to stick with the leaders. Next up, HOLX, big breakout on Friday. Look at all this sideways consolidation. Nice volume. Actually, right after I get off this, I might be buying the stock on today's pullback. I love this breakout here, sideways consolidation. If I go up and look at the PPO, I bet it's back at the 0 line. Very close, came all the way back down, makes the breakout. Look at the volume on Friday to confirm. Now it's pulling back. Maybe it gets as low as the 20-day. This is a type of stock where I might buy half, and if it hits that 20-day, I'd buy the other half. But Hologic is one I definitely would be interested in today. And then finally, just the overall, I said biotechs earlier. Look at the biotech breakout on Friday. And if we pull up a longer-term weekly chart, and I'm going to go back even further, let's go 10 years. Biotechs didn't do anything for quite a while. But when the group gets going, look at what happened for 3-4 years. We are just look at us trending up above this 20-week moving average and breaking out above 5 years of consolidation. That to me is very, very bullish. Healthcare is already showing that it's a leader in this new pandemic phase. And now you've got biotechs, one of the fastest moving groups, just breaking out. I think this could be the start of something really big long-term for biotech. So I'm a big fan of biotechs. I've said, IBB, XBI, for those that don't want to try to pick individual stocks, I think those ETFs look good. I can tell you I'm an owner of the IBB in one of my retirements. I love the IBB because if you look at the component stocks, it has a number of the stocks that we really like. I think Vertex is in here. I think our Regeneron, REGN is in here. Seattle Genetics, SGEN. I'm pretty sure all of those are pretty decent components from a percentage standpoint of IBB. So that's why I went with this one. So I just, maybe I'm going to suffer a little bit by having other biotechs that maybe aren't as strong. But biotechs to me, that's one of the areas that you got to be a little careful with individual stocks because all you need is one bad product announcement and you get hit pretty hard. So this is a group that I tend to be a little bit more ETF oriented. I mean, I still like the individual stocks, and I own Vertex, I own Seattle Genetics, I own Regeneron individually as well. But for a really sizable play on the biotech space, I think an ETF makes more sense. All right, that's it for today. Went way over today. It's probably the longest Trading Places Live ever. I did send out to all of our Earnings Beats member a state of the market late last night. Just, with all the move down, I'll just show you this S&P 500 chart. When you get a big move down, heavy volume, and you get a recovery, looking at what happens during that is really important. I can't stress how important that is because what you've got is a lot of folks repositioning and reallocating. And especially with what I talked about earlier with gap downs and then certain areas being bought, other areas being sold during the day, I think that repositioning, I'm going to say just about every Earnings Beats member would probably agree with me that our strong AD and weak AD chart list that we put together were very, very timely and have helped improve our chances of success in trading. Well, in a smaller respect, what we've seen here over the last 10 days or so has been just a kind of a small picture of this: down, back up, down, heavy volume, back up. And so I wanted to kind of evaluate that as we get ready to head into another earnings season to see what's been moving, where. And not too surprisingly, I saw almost the same groups leading over this 10-day period that I saw leading during this whole period here. There were some exceptions and some differences, but I put in there the top 10 industry groups that I liked from this period, and you'll see some familiar names as to what we saw also back here. The last thing I'll mention is that because of this, I am developing a new chart list for our members, and it's going to be, we've got the strong earnings chart list, so I'm going to call this the strong future earnings chart list. These are going to be companies that are in those strong industry groups, leading stocks in those strong industry groups that are not already on our strong earnings chart list. So these are companies that Wall Street is favoring as we head toward earnings. And if they're not already on our strong earnings chart list, so if they're not already on this chart list right here, which currently has 307 stocks on it. So if we've got strong stocks and strong industries and they're not already on that list, they're going to be on the strong future earnings chart list. So I think it's another group that you might want to be looking at as we head toward earnings. So pretty important stuff, good stuff. Anyway, all right, let's go ahead and wrap this thing up. Been too long. I got to go see if maybe there's any trades to make too. But anyway, everybody have a great day. Be back tomorrow over at Stock Charts TV for the next Trading Places Live. Everybody have a great day. Happy trading.